When will the Fed cut interest rates? This question has been open for a couple of months now, and Friday's non-farm payrolls report is expected to trigger another round of discussion about the timing of U.S. rate cuts, likely causing extra volatility in the U.S. dollar. Meanwhile, a rate cut decision in the Eurozone is a done deal this week, and perhaps it might be also a strong case in Canada. So let's have a look at what the technical signals suggest about dollar yen, euro dollar, and dollar loonie in this week's technical outlook video. So starting first with dollar yen and the US non-farm payrolls report. The forecast suggests a rebound in jobs growth and a steady unemployment rate, as well as stable average hourly earnings, which should be dollar positive. But looking at the technical indicators down here, we can see that the RSI, the stochastic oscillator, are showing are signaling lacking buying interest. So that suggests that a downside correction might be more likely than an upside one, especially after the creation of this bearish engulfing candlestick pattern over here. So if the data disappoint, then we may see a negative correction, probably a break below the 20-day moving average, and the 156.35 territory could confirm additional losses towards the 154.50, 155 territory, where this broken descending trend line and the 50-day simple moving average are both placed. Below that, I would pay attention to the 153.60 territory and the 153 number. This is where the 50% Fibonacci tracement of this up leg as well as this key constraining line are located. A break below that territory would worsen the short-term outlook. Now, if the data suggests a resilient US economy and justify rate cut delays, that could take dollar yen towards the 157.80, 158.40 key resistance territory, where the 2024 uptrend peaked. If we successfully overcome that wall, then the attention will turn to the 159.35 region. This is where this broken support and resistance trend line is located. And while the 160.20 peak from the end of April could also come into view, higher than that, the rally could stretch towards that thin ascending line at 161. Looking at euro dollar now and the ECB's rate decision, while expectations are for a 25 basis point rate cut this week, the decision is already priced in, so the rate announcement may not cause strong volatility in euro dollar, but the central bank's guidance could make the euro move, since investors are still uncertain about whether there will be additional rate cuts in the coming months immediately after this week's policy meeting. So if the central bank questions about when the next rate cut will take place, if it announces a hawkish policy guidance, while euro dollar could break the 1.0860 and 1.0880 resistance territory, which has been blocking upside movements over the past 2 weeks. A successful close above that bar could take euro dollar up to the 1.0940 and 1.0970 constraining zone, while higher than that, a break above the 1.10, 1.1035 territory and beyond these constraining lines over here could be important in confirming additional gains. Now, if while looking at the technical indicators, while the signals are mixed, the RSI is still moving sideways, slightly above its 50 neutral mark. The stochastics are also steady. So That suggests the weak buying interest. If the pair fails to climb above the 1.0860 and 1.0880 territory, it could revisit the 1.08 support region. Then lower than that, I would pay attention to the support trend line seen around 1.0755, while this falling constraining line at 1.0740 could also attract attention. A break below that might cause another bearish correction toward the 1.0690, though only a decisive close above this longer term ascending line which supported the market back in October and also in April might worsen the long-term outlook. And finally, looking at dollar loonie and the Bank of Canada's policy announcement, a rate cut could be a strong case this week in Canada, but investors are also positive that July's meeting could also be an ideal timing to cut interest rates. So if the central bank surprisingly keeps interest rates steady this week and also reduces the odds for a July rate cut, that could help the loonie to recoup some lost ground. Perhaps dollar loonie could ease towards its 200-day moving average and towards the support trend line seen around 1.3578 in this case. A break below that floor could then retest the 1.3537 territory, where the 50% Fibonacci retracement of this outlook over here is located. While lower than that, if the 1.35 level fails to hold, then all the attention will turn to the 38.2% Fibonacci mark of 1.3450, which is close to this support line over here. Alternatively, the pair will need a decisive close above the 1.3645 level and perhaps beyond the 20 and 50-day moving averages in order to reach the 78.6% Fibonacci of 1.3740. In this case, for such a rally to take place, the Bank of Canada will need to cut interest rates and also confirm an additional rate cut in the coming months. If the 1.3740 level proves easy to overcome, then the 1.3775 and 1.38 territory could be the next target. Higher than that, we may see another test around the 1.3844 peak taken from mid-April, a break of which could take us up to the 1.39 territory. Well, from a technical perspective, upside risks seem to be low. We can see that the RSI continues to trade sideways around its 50 neutral mark, and the stochastic oscillator keeps trending downwards. So downside risks are still intact in this market, but a dovish central bank meeting could help dollar loonie to stage another bull run. Perhaps a stronger non-farm report could also be a positive catalyst for this market at the end of this week. So that's everything I wanted to share with you guys. Thank you for watching and see you next time. Bye bye for now.